The shifts happening right now in the technology sector and the broader financial system have profound implications for the market, but the vast majority of people are completely misreading what is truly happening. On February 27th, 2026, OpenAI published a press release announcing a $110 billion funding round. This is the largest funding round conducted by any company ever. Mainstream financial media will tell you this is a definitive victory for human progress toward artificial general intelligence. They are pricing in a flawless future, but this is not what is actually taking place. If you peel back the layers of this record-breaking capital injection, you will find a deeply concerning structural reality. What we are witnessing is not traditional venture capital. Instead, these companies have increasingly turned to a convoluted web of circular financing. Wall Street and Silicon Valley giants are manufacturing a narrative to mask the underlying operational decay. For decades, the interests of tech monopolies were aligned with genuine market demand and innovation, but we are now seeing these interests diverge, and we think this is about to lead to the single greatest shift in financial history. This is not without precedent. We saw the exact same mechanics play out during the dot-com bubble. Back in the year 2000, telecommunication giants artificially inflated their revenues by simply purchasing hardware and capacity from one another. Today, history is rhyming at a multi-trillion-dollar scale. Retail investors are currently being positioned to pay the exit liquidity for what is shaping up to be the biggest tech illusion in U.S. history. This may be the most important dynamic to understand today. Let us break down exactly how this $110 billion illusion is financially engineered. On the surface, it looks like unparalleled institutional confidence. Amazon has committed to a $50 billion investment, and Nvidia has pledged another $30 billion. But this couldn't be further from the truth. You see, if we look at the actual contractual obligations, these are not investments. They are conditional vendor financing agreements as a direct exchange for Amazon's capital. OpenAI is obligated to spend $100 billion on Amazon's cloud computing services over the next 8 years. Nvidia's $30 billion injection operates on the exact same premise. It is the equivalent of lending someone $100 on the strict condition that they must use it. Buy $200 worth of your own computer chips. Doing this. The hardware and cloud monopolies are artificially inflating their own top-line revenue on their balance sheets, while simultaneously propping up an AI startup that has zero fundamental cash flow generation.
This left-hand to right-hand money game has a devastating consequence. It has led to a spectacular divergence between the company's paper valuation and its operational reality. To keep this circular machine running, OpenAI's business model foundation has suffered a structural fracture. Management has signed onto an astronomical $1.4 trillion in future, but they have absolutely no mathematical way to pay for this massive infrastructure debt. Why? Because the core consumer business that is supposed to generate the cash to pay these bills is aggressively bleeding capital. Mainstream analysts argue that this aggressive spending is justified. They claim compute is strictly constrained because user demand is off the charts. However, the internal data reveals a completely different story. OpenAI boasts 900 million weekly active users, but their conversion rate to paid subscribers is an abysmal 6.6%. If their computational supply was truly constrained by overwhelming demand, as they claim, they would raise prices. Instead, they launched ChatGPT Go for $8 a month, severely cannibalizing their $20 tier. They took Codex, a premium coding tool previously locked behind a $20 to $200 paywall, and began giving it away for free to juice the metrics. When a company burning billions slashes prices and hands out core products for free, they're not democratizing technology. They are ruthlessly padding top-line user growth to manufacture momentum for a massive IPO exit. The numbers do not close. In order to justify the current multi-trillion-dollar valuations of Silicon Valley's AI sector, it would mean that brute force computing power is essentially a money printer. It assumes that whoever burns the most capital will naturally monopolize future superintelligence. And we just do not have any concrete evidence of this outcome yet. However, if we shift our focus to the East, to the world's largest manufacturing supply chains, we see a completely different economic reality unfolding. If we analyze the primary macro-industrial data from Chinese technology giants entities like Alibaba, Baidu, and ByteDance, we find that they quietly exited this meaningless, cash-burning arms race for general large language models months ago. This is not just a one-off. This represents a structural shift in how incentives are aligned and how the markets are adapting. Based on first-hand macroeconomic data from the East, these conglomerates are actively pulling capital away from high-energy consuming, bottom-layer model training. Instead, they are redirecting those funds into highly vertical, closed-loop industrial AI applications and edge device monetization. This creates a brutal contrast in business models. While OpenAI is scrambling to pay $1 trillion compute bill, to the point of compromising its foundational ethics to accept military surveillance contracts, this pivot by Eastern capital proves a fundamental macroeconomic law. Any technology that cannot generate positive cash flow in the physical world will ultimately devolve into a Ponzi scheme. While Western AI startups rely on entities like SoftBank liquidating assets and borrowing money just to extend their runway, the East has already closed the commercial loop from raw data to tangible profit. This is the exact reason Wall Street is quietly panicking behind closed doors. If we conceptually overlay OpenAI, a $730 billion paper valuation, on top of the actual marginal cost to generate AI outputs, we can immediately see a terrifying divergence. According to industry data, when ChatGPT first launched, the cost to produce 1 million tokens was roughly $11. Today, that cost has collapsed to just 9 cents. The delivery cost is exponentially going to zero. This means the underlying technology is rapidly becoming a widely accessible commodity. Yet, the company's valuation is being pushed to the edge of the universe by the tech giants' left-hand to right-hand financing game. This has led to a spectacular divergence between the two. Now, on the surface, it looks like the broader market can easily absorb these upcoming tech listings. But this couldn't be further from the truth. You see, if we look at the liquidity drain, a massive systemic risk emerges. OpenAI and its peers are preparing for public offerings that could collectively drain hundreds of billions of dollars in market liquidity. If we compare the cash required for these AIPOs against the actual net buying activity currently seen in the U.S. stock market, the data shows this demand far exceeds the system's carrying capacity. They are not just pulling forward their own future returns. They are actively threatening to drain the liquidity of the entire financial system. The grand plan to monetize artificial intelligence is reaching a critical breaking point. The circular financing web engineered by tech giants to inflate their own balance sheets will eventually become mathematically unsustainable. Furthermore, as the marginal cost of computing power approaches zero, the technological moat that once justified OpenAI's premium is completely eroding. The current levels of uncertainty are not leading to a nominal collapse of AI technology itself, but instead a collapse in the real return of these extreme equity valuations. What does this all mean? It means investors are flocking away from the high-altitude illusions of Silicon Valley. Smart money has already seen through this $110 billion press release. They are actively retreating from companies that burn cash to manufacture user metrics and are aggressively reallocating capital into physical reality. We are seeing a structural flight to safety into hard assets, energy infrastructure, and the Eastern industrial conglomerates that generate absolute positive cash flow. This is exactly the reason we're looking at this so closely, because we think this macro setup is going to have real repercussions on financial markets. The entire financial system is about to reprice this illusion. Are you positioned correctly? Thank you for watching.